Hi and welcome to this video. My name is Julian Komar from Market Update Premium. We are trading growth and momentum stocks, and today I want to go with you through 5 essential CanSlim rules. CanSlim is the approach that I adopted for myself. So I took the very famous and very successful approach from William O'Neill and adjusted to my own personality and also to my own trading styles. And today I want to show you 5 very important rules that you should consider for your own trading too. So let's start with the first one. It's about cutting losses at 7% below your buy point. So William O'Neill used the 7% rule to place his stop losses in stocks. But, and this is very important, he also cut losers earlier, and I'm doing the same, and you should also cut your losses earlier. The thing is, if you see that a stock is not acting right or a stock is too weak, there is no reason to cut the stock earlier and over time decrease your average loss in a stock. That is a booster for your profitability in your trading approach. And let's look at Texas Roadhouse. So I bought Texas Roadhouse a little bit too late, so I bought that here on Friday the 25th October. And after I bought the stock, I immediately placed a stop loss order in my brokerage account 7% below my average entry price. So when I went into the stock for 185.40, I placed a stop loss order 7% away from my average entry price. That's important. It's not about the pivot point, it's about your average entry price, 7% away. Why 7%? It's very easy. William O'Neill at the time thought, okay, what is a good risk-reward ratio that I'm striving for in my trading? And he thought about a 3-to-1 profit factor or a 3-to-1 risk-reward ratio. And that means if you strive for a 20% profit or 25% profit, and you want to achieve a risk-reward ratio of 3, you have to place a 7% stop loss. And on the other side, it is also a great number because I'm able to trade a 15% position with just risking 1% of my trading capital. I don't want to go too deep here into position sizing, and money management, but 7% is a great rule. And I personally, I only place a wider stop loss in very volatile stocks. In that case, I go to 10%, but usually I use 7%. So, and you can see that 7% is below the breakout line, below this red line. So, and if I buy into stock, I always have in my mind that resistance becomes support again. So, and that means the stock should not fall back below this red line, which is the pivot point, or I call that the breakout line. If that is happening, something is wrong. And this is something where I tweaked also the CanSlim system a little bit. If the stock falls back into the base below this red line, I cut my position by 50%. This is a rule I took from David Ryan. And in that case, I'm able to reduce my average loss over time. So usually initial stop loss should be 7% below your buy point. And when the stock is falling back into the range or into the pattern, you can also apply the 50% cut rule. So that means cutting your position by 50% to decrease your average loss over time. Second important rule is take profits at 20 to 25% above the pivot point. And it's important that you keep in your mind it's above the pivot point, not your buy point. Let's look at the chart. Let's look at Deckers Auto Corporation. If you go back a little bit in time and look at the different bases, you can see that after the stock broke out from a base, you can see that it rallied for a couple of weeks here. So this is the weekly chart. And let's look how far the stock rallied. So this year was a 25% rally after it broke out from this base. Here's another base, and the stock rallied for 27 to a little bit more, maybe 30%. Here's another base. You can see the stock rallied for 26%. Here's a very small base and the stock rallied for 30%. So you can see that very often stocks rally for 20 to 25% before they start a new consolidation and a base. And that is something William O'Neill discovered too. He went through thousands of charts and discovered that most growth stocks rallied for 20 to 25% and then started to build a new base. And he said, okay, you want to take the most profits at 20 to 25%, either by taking partial profits in a stock or by selling the whole position. And there is a reason why that's very important. So before you give back all the profits and the stock starts a new consolidation and you maybe get stopped out of your stock, you want to protect what you have, as Paul Tudor Jones said. So that means you want to take profits off the table and keep your equity curve around the highs. So the equity curve is, the chart or the curve of your trading capital, and you want to reduce drawdowns, and you can do that by taking profits. And taking profits at 20 to 25% above the pivot point, not your buy point, can help you to do that. You can enter a stock a little bit later. So when you for example buy, say you buy here above the original pivot point, but in that case you have to go back to the pivot point and then start to look for 20 to 25% distance. So, and how to take profits? Well, it's very easy. Let's go down into the daily chart. So I entered Decker's Outdoor here and I bought it a little bit too late. That's really not a big issue, you don't want to fight for pennies in a stock. So I bought that after the breakout here, after this gap up, I bought into the stock. But now to calculate the 20 to 25%, I go back to the original pivot point, and that is the high here. And then I start to look for the distance from this pivot point. And you can see that here I drew in this red rectangle here, and I started at 22%, and I ended here around 25%. So for me, the take profit is a zone. It's not a fixed point. That's really important. You want to observe that, and you also want to include some more observations and criteria into the take profit price. So when you see that here's a round price level, say 230, then you maybe want to decrease your take profit a little bit, or you want to increase if you have another round price level or a very important resistance level in a stock. So, and when the price reaches this profit zone, you just want to execute. This is really important. It's not about fighting for pennies, it's about making money. And that means you have to sell that, and you go into your brokerage platform and you just execute the order. Even if the stock moves higher after that, you secured a 20 to 25% profit. And you can also see it differently and say, these are my bread and butter trades. You will have some bigger winners in your trading account from time to time. But these 20 to 25%, they are the basis. They are making sure your trading capital is around the highs, that you have a profitable year, and at the end, these are your bread and butter trades. Third rule, hold your stocks for 8 weeks if a stock gains 20% in 3 weeks or less. This is a very famous rule from William O'Neill in the CanSlim system. And yes, it's a little bit opposite to the second rule, to take your profits at 20 to 25%. But this so-called certainty rule is very important to hold on to big winners. And let's look at an example here. So this is Celestica. And you can see a wonderful base here in Celestica. And the stock broke out here after earnings. And in the next 2 weeks here, or in 3 weeks at all, the stock rallied almost 30% from the pivot point, not from your buy point, from the pivot point. You can see that it rallied 34%, and it rallied more than 20% in less than 3 weeks. And that means you have to hold on to the stock for at least 8 weeks and then reevaluate the situation again. That is really important, because this could be a potential bigger winner That could be a winner maybe going up 50%, 100%, 200%. You don't know. But, behind that move is a very simple thing. There is a lot of demand for the stock. There is a reason why institutions buy so aggressively into the stock that it rallies, 30% in just 3 weeks. And, William O'Neill selected all the big winners with this criteria to say, okay, the stock should rally very, very quick and with a high demand from the pivot point. And if a stock is up more than 20%, more than 20% in less than 3 weeks, you have to hold on to that because it could rally another, 20, 40, 100, 200%. And I mean, look back here, not every time this criteria works, but for the most big winners, this criteria and this rule can help you to stay invested into the big winners. And after 8 weeks, you have a look again at the stock and see, okay, is it strong enough? Does it have still great fundamentals? Is the story still valid behind the stock? And if all these things are true, you want to switch to another sell rule, and you want to hold on the stock maybe with the EMA 13 here in the weekly chart, or you want to apply the EMA 21 selling rule that I use very often, or you wait for a climax top and then you sell it into the strength. But this third rule, so hold on for 8 weeks if a stock is up 20% or more in less than 3 weeks, this helps you to really stay invested in the big winners over time. Fourth rule from William O'Neill, focus on top stocks with CanSlim characteristics. And I personally developed my own stock selection criteria over time. You can see that here in market search. I have my own screeners here. I maintain my own watch list. I share that with the members. I have also my own process to select top stocks. But the foundation of my trading is CanSlim. And that's a great thing, right? You build on a time-proven, very successful approach and you adjust it to your own personality over time so that you make sure that you have an edge in the market. And then you make sure that you can execute your trading system at best because it fits to your personality. Let's have a look at the stock here. So this is Comfort System. And let's go through a couple of criteria I'm looking for. So when you look here at the table, you can see the EPS from the last couple of years, the earnings per share, and you can see the estimates. You can see that FIX grew over time almost every year. So you can see it started in 2017 with just $1.74, then it grew to $2.85, and so on and so on. So over time it grew the EPS every year. And then in 2024, for the estimate, you can see 64% growth is estimated for this year, and for the next year it's 20%. So this is a stock growing very fast over the years in earnings per share. So this is a very profitable company. That does not mean that the stock will every year or in every bull market will generate a lot of profits. No, that's not the case. Sometimes this stock is also out of favor of the stock market. But it lays the foundation of becoming a high potential stock. So another thing what I'm looking for is of course the quarterly numbers. And here, this is what I call a wall of blue. You get much more insights about fundamental analysis and everything behind sales growth and EPS in my video course. But this here is what I call a wall of blue, because everything is blue. That means in every quarter the stock grew year over year in EPS or in sales. You can see that here 48%, 66%. 94, 49 in the last quarter. You can see very steady sales growth over the last quarters, around 30%, 40%. So, this is a company which is very successful year over year. And every quarter, the numbers grew. Then I'm looking for best ratings. EPS rating 99, that means the stock belongs to the top 1% of all stocks tracked by IBD when it comes to the earnings per share. Then I look for accumulation distribution rating. I want to see an A, but in that case it's a B minus. It's okay, it's okay. It's not the best rating, but I'm looking for A's here. Composite rating 99, that means the stock belongs to the 1% best stocks tracked by IBD. Here you can see EPS growth rate 32%. So this is what I spoke about when it comes to the yearly EPS. You know, on average, the company grew in EPS 32% in the last 5 years. Return on equity is very high. So cash flow is very high. Up and down volume ratio is something I'm looking for. It's 2. So every value above 1 means that the stock is under accumulation. So there is a demand. Number of funds grew in the last couple of quarters. So that means more and more funds are invested into the stock. And when it comes to the supply of the stock, I'm looking for shares and float. But this is something, you know, which is just a big plus. So if I see that shares and float is below 50 million, there is not much supply in the market. And that's definitely a big plus. In that case, it's 35%. And I always say to my members, you know, if a stock has less than 50 million shares and float, it can rally very fast. It can move very fast, especially if there is a high demand for the stock. Another thing what I'm looking for is, when I go to the daily chart, is the pre-tax margin. So, you know, I usually want to see pre-tax margin plus return on equity is around 50. So in that case, it's around 40, which is okay, you know. But overall, if you look here at the if you look at the stock here of Comfort System, it had a very nice rally. And there is an important thing in CanSlim, and it's about the N in CanSlim. This is new. What the hell drives this stock price to these high numbers? You know, a rally from, what is it here, 60 to 500 in 3 years. What is driving the rally here? You know, on one side, it's definitely investing in infrastructure. On the other side, and you can see that here, I wrote it down for my members, you know, there is a high demand from data centers for heating and cooling and plumbing, and Comfort System offers that. And this is very important. This is why I'm doing so much, you know, research about stocks, that I can also share with my members, you know, what is the story behind the stock? What is the reason why this thing is so attractive to institutions? You know, usually you would not expect that if you just look at, you know, the explanation here from market search. You would not expect that they are in a hot theme like data centers. And we discovered a couple of these stocks this year, all building and construction stocks that are involved into data centers and, you know, building e-commerce warehouses, etc. And that really drove the stock price in a lot of these stocks. So you can see on one side you want to focus on top CanSlim characteristics. It's okay, you know, if just 80% of the characteristics are fulfilled, and you really want to focus on the N in CanSlim. So making sure that there is something new, that means new products, new services, new management, something like that. And in that case, with Comfort Systems, the new is they are able to attract new customers for their products, data centers and, you know, e-commerce, etc. And that really is something important and very interesting to select great CanSlim stocks. Fifth and last rule, buy after indices followed through from a correction. This is something the most CanSlim traders, and especially inexperienced CanSlim traders, really underestimate how important that is. I mean, what is the basic of CanSlim? What is really behind the concept of CanSlim? You look for very high potential stocks that have an outstanding relative strength against indices. You know, they are resisting corrections in the stock market. They are consolidating while the indices go down. And as soon as the indices start to move higher again, you buy into these leading stocks or you add to them. And they are breaking out to new highs, new 52-week highs, new all-time highs first. And that gives you an advantage in the market. And, you know, that makes it also very easy to find real good winners and true market leaders when a market is in a correction. And that's why I always say to my members, welcome corrections in the market. It's not a bad thing. It makes it so easy to find winners. I personally, I don't follow the original IBD CanSlim market trend model with these follow-through days, etc. I adopted a more simpler approach over time, and I adopted the March market trend system for myself. This is nothing I developed by myself, but I adopted that, and I said, hey, this is really, really good. And you get all the insights about that in my video course, and of course my members are using that too. And this is usually how I look at the market. You can see green backgrounds, yellow backgrounds, red backgrounds. I don't want to go too deeply into that, but every time when we get a new green background, that means we get a buy signal. That is very similar to the concept from IBD and what CanSlim uses about the follow-through days. So, but you don't have to pay for that. You don't have to pay for a subscription for IBD. You can use that with 2 simple moving averages and get some buy signals. Of course, there are some rules behind the moving averages, but that really, really helps you to make good timing decisions. So, and when are we buying? So usually we start to buy as soon as we have a green signal. But some of the true market leaders even break out before and rally higher. So that means even in this, when you have a red background, 1 or 2 of the super stocks, they are breaking out before. And you have to apply some certain rules about that, and you need some experience to buy into them. And you can see the small rocket symbols here. These are rally days, and the true market leaders, they usually break out on these rally days, and you have to go a little bit into the risk. But the majority of stocks, they give buy signals after the market followed through, and after the market, or after we got a green background here and a buy signal. That's important. And if you stick to that, and my members are doing that, and they learned that over time, when you stick to that you focus your buying activity when the background is green, then you have the probabilities on your side. A lot of the normal stocks and the normal buy signals, they will fail if the market is in a short-term downtrend. They will only work if the market is in a short-term uptrend. And that's really important. Only the real true market leaders, they give some buy signals earlier, but the majority of stocks, and also the majority of CanSlim stocks, they break out from bases or move higher if you have a follow through in the market. And that's really important. So, and 80% of the stocks follow the general direction of the stock market. And that's why you want to only buy if the market is moving higher after a correction. And you want to buy into them, and this is really important, you want to buy into them if the market is coming out of a correction, like here, for example, in September, or like here in November, or we can also go back in time. And every time when the market is coming out of the correction, when the background switches, we are really getting into the buy mode, and stay in the buy mode as long as the the background is green and we have a clear buy signal in the market. That's really important. So I went through all the 5 essential CanSlim rules with you. If you want to deepen your knowledge, if you want to gain more experience in that, you can look into my video course, or you can start a 14-day free trial of my Market Update Premium service. So join a lot of passionate and experienced growth traders and learn from them, and also get engaged in the discussions and get in contact with me. Otherwise, you can also follow me, of course, here on YouTube. You can follow me on Twitter or subscribe to my free newsletter.